Today's top three things in my notebook: number one, the euro; number two, oil; and number three, the bond market and or the 10-year bond yield, however you want to look at that. Looking at the euro first, we've had Draghi jawboning. We talked about this on Friday, but again, continued jawboning and fear-mongering associated with Draghi trying to get what he inevitably thinks he'll get, which is help from the Europeans to do quantitative easing. Now again, he's getting more aggressive because he doesn't have the German support. And again, the currency market's getting just equally upset about this because they think it's going to just end badly for the Europeans anyway. What's also happening, again, with the euro immediate term trade oversold today at $1.19, is that European equities continue to break down. So again, this isn't your Draghi QE of before. Don't forget that on any whisper of QE, equities used to go up. Now, in fact, the European equity market continues to break down. You're seeing this from Greece to Russia, across Spain, Italy, and back again. The FTSE remains broken too. The only thing that's really holding in from a trend perspective is, in fact, the DAX, and that's probably because it doesn't have as much oil weight in it. Now, point number two on oil, getting an immediate-term trade oversold signal, really an exhaustion signal at this point on the downside of oil. You can call that anywhere between 51 and 52. So again, if you have your shorts on there in the energy space, or if you keep putting them back on the bounces, congratulations, now you can cover some of those. Again, deflation is pervasive. All this does is ensures that you're going to have a series of lower highs in both bond yields, euros, and oil. Let me say that again. They're all correlated, don't forget. Bond yields, euros, and oil. So again, that's an explicit deflation signal, and it's also a growth slowing signal globally. A lot of people don't think that that is a global signal. Well, we'll take the other side of that. And again, just look at it for what it is. Again, look at oil as an oversold signal today with an immediate term upside target, I guess, on the bounce could be right around 55 and change. Now, finally, the 10-year bond yield had a fantastic move to the downside again on bad economic data on Friday. I'd be remiss not to repeat and rinse and repeat and repeat and repeat that the December data, whether you look at the ISM in the US or the PMI, and again, you're going to get the services number later this week and then the employment number, all this data slowed in December. So again, a lot of people are talking about this 5% US GDP number. Obviously, that's not a year-over-year number. So expect, number one, Q4 GDP to be slower, and number two, the annualized year-over-year GDP number to have a low 2 in front of it at a bare minimum. I guess that's what you'd have to bake in. So again, the narrative is going to have to shift from +5 to +2 or something like that. Again, you have to look at GDP on a year-over-year basis. That's what bond yields do. That's why bond yields are closer to 2% than they are 3%, because the 10-year bond yield is reflecting a 2% or falling GDP growth rate on a year-over-year basis. So those are your top three things.